Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and attention and energy. And if this is the first time you're listening, welcome to the podcast. And today's conversation, I'm going to talk all about financial planning considerations as you prepare for practice ownership. And over these next 3 podcast episodes or so, I want to talk about different financial planning considerations at different stages of practice ownership. Today, we'll talk about leading up to preparing to get into practice ownership, whether it's cold start or purchase into. Next week's conversation, we'll talk about financial planning considerations from doors open through the early years. And finally, in the third conversation, I'm going to talk all about financial planning considerations for a more mature practice. What are some things you need to think about? And there's different things you need to think about in every stage of ownership. So I'm excited to dive into this, at least on a high level. Of course, there's so many details that go into all this, and it changes throughout your career and over your life, but I'm excited to dive into this. This is a topic that really excites me. I am fascinated by practice ownership and all that goes into it, from the business aspects of it to the financial aspects. So I'm excited to dive in. As I do, if you have any questions about any of this, feel free to reach out. My email is Evon, EVON, at optometrywealth.com. And with that, I will go ahead and dive right in. So what are some things you need to think about from a financial side, from the personal financial side, as you prepare for, as you lead up to practice ownership? Whether you have just recently graduated, whether you are currently associating right now, an associate at a different practice. If you are considering going that direction with your career, what are some things you need to think about? And this is a big career decision. I mean, it is no small task to either cold start a practice from scratch or to purchase into one that's already established. Either direction, there are challenges. There are going to be a lot of moments of stress and a ton of work that goes into it, but it can also be so rewarding. It can be so rewarding. And I say that as someone who cold started my own financial planning firm. So what are the top financial considerations that you need to keep in mind as you prepare for practice ownership? And for me, in my mind, the top 2 financial considerations are you want to focus on 2 things. You want to focus on cash flow flexibility, meaning creating as much wiggle room as you can between the amount of income coming in and the expenses that are going out. So you want to focus on cash flow flexibility and building up cash or liquidity. Building up liquidity. It's going to be very important to start to build up cash for yourself. And it's really important for 2 reasons. And I'm going to approach this first from the perspective of a cold start, and I'll talk about purchasing into established practice in a little bit. But from the perspective of a cold start, these are really important, number one, because you want to give yourself a long enough of a financial runway to get that new practice up and running in the first 2 to 3 years, because you're not going to be able to draw an income from that practice, at least enough to cover your lifestyle like you would as you were working full-time. You need to allow that practice to grow without pulling resources, without pulling dollars from it. So you need to have a plan for how you're going to cover your living expenses, how you're going to keep the lights on, put food on the table, have a standard of living, and keep your family happy. Ultimately, your new business is only going to go as far as your personal finances and your ability to pay for your lifestyle expenses. So getting a game plan together to make sure that you have enough coming into the household or enough cash built up to get that financial long way run enough so your business can grow. Another related point is that having a good amount of flexibility with your cash flow, and especially having cash in the bank, definitely can help to mitigate or lower some of the stress of early business ownership and can help you to not stress so much about the personal finances and to focus on making good long-term decisions in the business. The second reason, or the second purpose that this is so important, is because you need to prepare to go for practice lending. Ultimately, you're not going to have a few $100,000 saved up, the $400,000 to $500,000 saved up in order to fund this new business on your own. You're going to have to go to a bank for lending, and banks will lend 100% financing, both for cold starts and for practice purchases up to a limit. But the bank will lend you 100% of the money you need in order to get your brand new business up and running. Even if you have no prior business ownership experience, they're still going to do that. And think about why that is. This is such an important and interesting point, in that think about why it is that a bank will lend you money, even if you've had no prior ownership experience, even if you've had only a few years of practicing. Why is that? Because the odds of your success are so high. The odds of a success of a cold start optometry practice are high enough that a bank is willing to underwrite and lend to you, even if you have none of that prior business experience. So keep that in mind as you're going towards and thinking about whether a cold start is possible, whether it still makes sense today in this environment or whatever it is. You might hear a lot of doom and gloom about the future of private practice optometry, but just keep that in mind. Your bank is still willing to lend you 100% of the funds you need to get this up and running. But the only thing you really have to present to show the bank that you are creditworthy, that you are trustworthy enough for them to lend you that 100% financing, is a business plan and a feasibility analysis for the business, and how you've managed your personal finances. Especially if you're trying to do this a year, maybe even 2 years out of optometry school. So you need to prepare your finances in a way that shows the bank that you are creditworthy. And what they're going to want to see is that you have enough cash coming into your household to cover your living expenses and be able to pay their debt payment. And every bank is going to have different underwriting requirements, right? I don't want to speak for all of them, but they're going to want to make sure that you have a cash flow with a buffer above your core lifestyle expenses, and showing your ability to pay their debt payment. That's what they're concerned about. And many of them are going to want to know that you have cash in the bank. You've built up some liquidity. Now, they may differ on how much they're going to require, but your ability to pile up cash and to put some cash away and build up some liquidity is going to show the bank that you're able to manage your finances appropriately. And I have an episode with a conversation with a lender, a banker from Wells Fargo, Practice Solutions. So I'll put that link to that in the show notes as well. Listen to that, hear what are some of the requirements, at least from Wells Fargo's perspective, and what they're going to require from you if you're going for a cold start. But preparing your finances is a huge part of going towards and presenting yourself to the bank and getting qualified to take out that lending, to get your business up and running. So for giving yourself a financial runway and to preparing for practice lending. So let's talk about how to get a game plan for your cash flow. What does that look like? Well, it really comes down to basic budgeting principles, right? So this isn't advanced math here, right? It can sound simple, but it's not always easy for everybody. So what does that look like? Well, first of all, you want to take accounts. You want to look at what income is coming into your household. Maybe you're married and your spouse is working. Maybe you're associating part-time, and this may actually be a requirement for different banks for you to actually associate at other practices part-time a certain amount of days a week. But maybe you're already doing that, right? So just take account of what income is coming into the household that's going to help you cover your bills and cover that debt payment. And then think about your expenses. What you really want to do is get clear on where your spending is going and take a look at it and see what's valuable and what's not valuable. What's required in order to maintain a reasonable standard of living and what's not. You ultimately want to keep expenses as lean as reasonably possible. And I want to emphasize reasonably, because if you're married, if you have a family, you got kids, you're not going to live on top ramen and rice and noodles, for these next couple of years, right? You're going to need to maintain a certain standard of living for the family. And And really to get your spouse on board, which is hugely important if you're getting into business ownership, to get your spouse on board, you really need to have a conversation and have agreement on what is an appropriate lifestyle and how much you can trim your expenses reasonably. So go through this exercise of looking at your expenses, trimming away what's not valuable, what can be set aside until the future, until your cash flow is a little bit better, and see what you can do there. And it's important to just watch as you go. As you get into business ownership, watch that internal spending, watch that household spending, just like you would the spending of your business. Watch the cash flow of your household as well to make sure you're staying on track there. One question that does come up a lot is, should you, if you are contributing to a workplace retirement account, maybe a 401k, maybe a simple IRA, where you're working at right now, should you lower those contributions in order to put more cash away towards or preparing for practice ownership? And I do think that's actually a reasonable thing to do. Your cash flow priorities have changed, right? You're no longer saving in these retirement accounts for the long-term future. Your priority for cash flow is to get into business ownership. So I would say that is definitely a reasonable thing to do. Obviously, the best outcome is you can continue to contribute to your retirement accounts. You can also put away dollars into savings and start to build up your savings a little bit. But if you do find yourself needing to lower those retirement plan contributions, I think that is a reasonable thing to do in anticipation of getting into practice ownership. And one thing you do need to keep an eye on is that company match, though, because if you're in a like a safe harbor 401k plan or a simple IRA plan, what you're likely to see is that there's no vesting schedule on those matching dollars. What that means is that if you do end up leaving your employer, you are very likely able to take their matching dollars with you as you go. And so that match is a part of your compensation that you do want to take advantage of. You do want to contribute in order to get that. And if there's no vesting schedule, if you can take it with you, something to keep in mind. And I guess for the practice owners listening, something for you to keep in mind as well. So that's something to keep an eye on. If you do want to invest, I mean, you can invest outside of your retirement plan. I do think it's reasonable to not put too much dollars away into this retirement plan that you really can't access as soon as you want. You can invest in something that's just called a taxable investment account, or an individual brokerage account, or joint account, or trust account. Those are all different names naming the same thing. And that's just an investment account you can open. It's not retirement specific. You have full flexibility in how many dollars you want to put into it and when you can access those dollars. There's no penalties. There's no restrictions. There's some differences in how these accounts are taxed because the income in these accounts do end up on your tax return. If you sell things for a gain, those capital gains end up on your tax return. But what you lose in tax advantage, you gain in flexibility. So if you really do want to invest, you can invest in something like that. The other alternative is to use a Roth IRA, in that if you are able to contribute directly to a Roth IRA, meaning your income is low enough to where you don't have to do a backdoor Roth IRA contribution, you can contribute directly to the Roth IRA. If you do that, you can actually you can withdraw from the Roth IRA up to the amount of dollars that you put into it. So you can take your own contributions, your own deposits out of a Roth IRA without tax or penalty. So that's another thing to consider. If you need to put dollars somewhere, the Roth IRA might be another way to go. If you're doing the backdoor Roth IRA contributions because your household income is too high to put dollars directly into it, it changes a little bit because you're not technically contributing into the Roth IRA. You're contributing to a traditional IRA first, and you are converting to a Roth IRA. So conversions actually have their own 5-year wait period until you can pull those conversion dollars out without penalty. You've paid the tax, but you're still worried about penalty. So Roth IRAs are something to continue as well, or something to consider as well. And one last thing I want to talk about is debt. And that's an interesting thing in the life of an optometrist because it ebbs and flows. It's definitely a part of your life. As soon as you leave school, you have student debt. You might get a mortgage. You might get practice loan. You might pay some of it down and incur more down the road. And you want to pay careful attention to the way you're handling debt as you prepare for practice ownership. Be careful about the debt decisions you make. If you know practice ownership is in the cards soon or in your near future, be careful about adding big amounts of debt right as you're approaching this. So getting a new house with a higher mortgage or with a larger mortgage, or getting a new car right as you're about to go through underwriting. I've heard a story where someone purchased a Tesla right in the middle of underwriting for a practice loan. So don't do that, definitely. So be careful about your debt decisions as you prepare for that. Remember, if we're trying to have maximum flexibility in your cash flow, adding on additional debt payments squeezes the amount of cash flow that's available for you. And the higher the required payment, the less flexibility you're going to have and the tighter your cash flow is going to be. You may want to look at your debts that you have right now, see if it makes sense to restructure them, to maybe lengthen the term and to provide a little bit more, to lower that required debt payment and to provide a little bit more flexibility. It's a little bit difficult right now at recording because interest rates are where they're at, but something to consider is, can you restructure or refinance your debt to make it, to give yourself more breathing room in your cash flow. Another thing to really be careful about is how you handle student loans. And your lender will absolutely lend to you money even though you have student loans, right? So your student debt in and of itself is not going to prevent you from getting practice financing. However, the size of your student loan payment is definitely going to factor into that. So be very careful about putting all of your dollars in paying down student loans at the expense of saving up cash in a savings account or building up liquidity. And paying down your student loans aggressively is a perfectly absolute legitimate way to tackle your student debt. And for a lot of people, that is the right approach. Put as much as you reasonably can into this debt, tackle it, get it off your balance sheet, and then move on. But if you're doing so at the expense of building up the cash you need to prepare for this important career goal, then perhaps that isn't the right route for you to take. There are other approaches to tackling that student loan debt in line with that practice ownership goal. And you need to keep in mind these other goals you have when planning on how much you're going to pay into that student debt. Another thing to be really careful about and to plan for carefully is refinancing out of the federal student loan system, especially if you know that this is the route you want to go. Especially be careful about refinancing to too short of a term period to where your mandatory required payments are taking up quite a bit of your monthly cash flow. I would say if you are planning to get into ownership, just evaluate really carefully whether it makes sense to refinance out of the federal student loan system and lose the flexibilities that are available to you in that federal student loan system. It really needs to make sense for what you're trying to do. And, for example, if you know with certainty you're going to pay down this debt before you want to get into ownership, well, maybe that makes sense if you have that game plan. But otherwise, I would just say evaluate that very carefully. And once you've done that, once you refinanced out of that federal student loan system, you cannot go back. And your only options at that point to create more flexibility are to refinance to lower rates, which who knows when we'll see that, or to extended terms, to longer terms. On the other hand, something you might consider just sort of as a stepping stone strategy for paying down your debt is to use an income-driven repayment plan, especially as you're preparing for ownership, to give yourself more flexibility in your cash flow to allow you to build up more cash, especially when you look at this newly announced income-driven repayment plan, the SAVE plan. There's a more favorable payment calculation. There's no unpaid interest accruing, so there's no interest penalty if your calculated payments are lower than your charged interest for that year. And as an example, you think about a recent graduate. Maybe you've never made payments because you've graduated within that COVID forbearance, and your first couple years of payments might be based on very low income or maybe the lowest income you'll see throughout your career. So it might make sense to use something like a SAVE plan in that scenario. Have very minimal payments, allow yourself to really sock up cash and build up cash. And then later on, when your cash flow allows for it, or when you're ready, flip the switch and start to pay down that debt more aggressively. Or when you think about cold starting, and if your income drops around that point where you're now only associating part-time and your practice is not really seeing high amounts of taxable profit, that might be an opportunity to create more wiggle room in your cash flow by using an income-driven plan. And that may not be the best long-term solution for you. And it likely is going to be a little bit less interest optimal. However, our goal is to get you into practice ownership. And if that's what it's going to take to help you, to give you that wiggle room, then that's what you should do ultimately. Another thing to keep in mind and just to think about is who owns debt. When you think about things like car payments, debts like that, if you're married, maybe it makes sense for your spouse to own that debt, to have that debt in their name versus yours, to sort of improve your own debt to income ratio as a part of the underwriting. Mortgages, I'm not sure how much that matters in whose name, because from my conversations with lenders is that even though you don't have that mortgage in your name, they're still going to expect, or really build into their models that you have some sort of living expense, right? So I'm not sure you can avoid it from that perspective. But some of these other debts, just keep in mind who has the debt in whose name. But as a part of that underwriting, if you need to bring in your spouse's income in order to qualify, then it's also going to bring in their debts too, right? So it's all or nothing. So just keep that in mind in terms of the debt. And then lastly, the thing to think about is saving and liquidity, right? Once you know your income, once you know your likely expenses, then you see the gap. You can take a look at that gap and say, well, how can we cover that? Well, part of the way you can cover that is by, again, finding additional part-time income. Another way to help tackle that gap, that living expense gap, is to build up additional liquidity and use some of your savings in order to supplement your income. So that's where savings is really helpful, is having enough to potentially offset, even if it's unexpected expenses as they come up. Another thing that savings is important for is if you have out-of-pocket expenses that come up before you get the financing from the lending. And think about if there's any startup costs that you need to cover out of pocket, attorney fees, lease or construction costs, any other professional fees, things like that. Just keep that in mind too. That cash is going to be helpful there. If you're buying a practice, right? So a lot of that's talking from the cold start perspective, where you're sort of starting from scratch. There's no revenue to speak of. That financial runway is really important. If you're buying a practice, it's a little bit different, right? Because you are buying an established practice. There's a financial history to look at. And hopefully you're buying a practice, and your bank's definitely going to want to see this. You're buying a practice, hopefully, that has enough cash flow to tackle the business operating expenses, to provide a reasonable wage for yourself, to cover your own living expenses, and to tackle the practice finance debt payment. The bank is definitely going to want to see that there's enough cash flow to provide an income for you as an optometrist working in the practice and cover that debt payment. When you are purchasing a practice, there's already some sort of built-in income for you, right? You're going to be working full-time in the practice. There's going to be some income for you to cover your lifestyle expenses. So it's not necessarily about making sure that you can put food on the table, but you still do want to keep your expenses lean so that you can have the extra cash flow that the business needs in order to grow in the way that you want to grow, and to reinvest in that business in the way that you want to reinvest. Although I have seen where there's husband and wife couples, both of them have bought in 50%, and maybe one spouse is still working part-time because the business is not busy enough yet to support them working full-time hours in the practice. But so when you're buying a practice, it's a little bit different, but a lot of those same considerations when going for lending are going to be the same. You definitely want to have enough liquidity in your life. You want to build up some cash in anticipation for that. Some lenders are going to want to see that you've built up like 10% perhaps of the loan value. So they do want to see that you built up some liquidity, even though they're going to provide 100% financing. They do want to see that you have handled your personal finances and you've built up some cash. And if there's no cash built up, if you've been working for 3, 5, 10 years and you've not built up any cash, you have no cash in the bank, they're going to wonder why. It's going to be a red flag. So keep that in mind. Preparing for lending is really what's important there. So those are some of the personal finance considerations. It really is about building that personal finance runway, especially for a cold start, leaning down your expenses as much as reasonably possible, but still maintaining that reasonable lifestyle, having cash in the bank to help bring down that stress a little bit and help you prepare for any unexpected expenses in your household. And then really one of the most important parts is to prepare for practice financing, to go to the bank and get lending so you can start that practice or purchase that practice or buy into that practice. The next thing, those are on the personal finance side. Now I want to talk a little bit about the business, right? As you're going to prepare to start that business, what you're probably going to need is think about entity selection. You're going to need to think about what type of entity, what type of business entity should you be opening, should you be using as you get into ownership. And this works both ways, right? If you're a cold start, you're going to open an entity from the very beginning, from scratch. But even if you're buying a practice, it's very likely that you're doing an asset purchase. So you're going to buy the assets. Your business entity is going to buy the assets of that other business. You're not going to buy the shares directly. So in both situations, the entity selection part's important. And this is really where a mix of advice from your tax professional, your attorney is very important, and your financial advisor. The advice from your whole professional team really becomes important here because there's considerations that touch all these different components here. Most of the time, what you see with a new practice, a new business, is that it's going to be some type of pass-through business entity, whether it's an LLC or it's an LLC or a corporation taxed as an S corporation. So it's going to be some type of pass-through business entity. And what that means is that the business itself doesn't pay its tax, doesn't pay tax on its own. All of that net income, all of that taxable profit from the business passes through and ends up on your personal tax return. And you'll see that on your personal tax return. So most of the time, you're going to see that with a service business like an optometry practice. Of course, there can be differences between the legal entity that you create and the way that it is taxed. I talk about this a whole lot more in an episode I did just about the differences between different business entities. So I'll throw a link to that in the show notes. Go ahead and listen to that. But when you think about, or really when you talk with your professionals, when you talk especially with your attorney about which entity to select, there's going to be a bunch of different considerations. There's going to be tax considerations. So you're going to think about how that business is taxed and how much profit is coming into the business. The QBI, qualified 20% qualified business income deduction, how that works with it. Owner comp requirements, so how you're required to pay yourself. How fringe benefits are taxed to you as the owner. Things like health insurance, group life insurance, stuff like that. There's also going to be some non-tax considerations. So fees in order to file taxes, in order to stay compliant, things like that. What are the fees associated with that business entity? What are your state requirements, which is really important. Each state is going to have its own separate requirements. For example, in California does not allow an optometry practice to function as an LLC. Instead, what they require, you're going to have a professional corporation. And most of the time, that professional corporation, you're going to be choose to be taxed as an S corporation. Texas has, you're going to own a professional association. So each state has its own nuances, which is why it's really important to find a professional in your state that knows your state's laws, or really just that knows optometry. There's also, you want to think about the compliance requirements. What are the things you need to do to stay compliant with your business entity and to maintain that business entity? There's some non-tax considerations and then liability protection, which is really the main reason you open a separate business entity outside of yourself, is to protect your personal assets, your personal net worth from the liability within that business. And those are some of the many considerations that you're going to think about when deciding which business entity is right for you. But ultimately, just lean on the guidance and advice of good professionals in your corner. Have a good business attorney. Have a good tax professional, whether it's a CPA or an EA, enrolled agent. Have a good financial advisor in your corner. Just lean on your professionals. Let them guide you through that process there. It's not something you necessarily need to go out and try to do it all on your own. And then lastly, you just want to build up your basic financial infrastructure, which is a fancy way to say open bank accounts. You're going to want a primary checking or operational account, maybe a savings account, and then perhaps a tax account where you can set aside dollars each month or each quarter to prepare for tax payments. So start to build up your bank accounts, assign them how you feel is right. And then also credit cards. Get your business credit cards as well. Get all of that basic stuff. Talk to your your insurance broker about getting business ownership liability protection. So some of those basic insurance policies as well that cover your business from the liability needs. And of course, malpractice insurance, which you probably have already in order to practice anyway. So hope this was helpful. Those are all the different things that you'll think about as you go for practice ownership and prepare your personal finances. Next week, we'll talk all about some of the financial considerations in the earliest years of business ownership. What are some of the things you'll need to think about? So stay tuned. We'll see you then. In the meantime, check out all the links and resources I mentioned in this episode in the show notes, which you can find by simply scrolling down in whatever app you're using, or going to my website, the Education Hub at my website, www.optometrywealth.com. And while you're there, feel free to schedule a no-commitment introductory call. We can talk about all these different things and whatever else is on your mind financially. And we can talk about how I've helped optometrists all over the country navigate some of these same decisions and same questions. So hopefully we'll catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mindrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.